All right, let's get right into it. So, you're running a successful LLC. That's fantastic. You're probably loving the profits, but maybe not so much the tax bill that comes with them. Today, we're talking about a super important financial crossroad for your business, figuring out when it's time to graduate from a standard LLC to an S-Corp. And that's really the big question, isn't it? As your business grows, could its current structure be silently siphoning thousands of dollars away in taxes that you don't even have to pay? For a lot of profitable LLCs, the answer is a pretty shocking yes. The number at the very heart of this whole thing is 15.3%. This is your self-employment tax rate. It's basically Social Security and Medicare taxes all rolled into one. And believe me, for a standard LLC, it can take a massive bite out of your hard-earned cash. So first, let's unpack what I like to call the LLC tax trap. It's the default setting for so many small business owners, and just understanding how it works is the first step toward potentially saving a whole lot of money. Okay, so here's the crucial part. With a standard LLC, the IRS basically sees no difference between you and your business. They're one and the same. And what that means is that 100%, literally every single dollar of your net profit gets hit with that 15.3% self-employment tax. And that's on top of your regular income taxes. But what if you could change that equation? Well, you can. And that brings us to the solution, electing to be taxed as an S-Corp. The best way to think about it is like a strategic upgrade for your business's tax life. I absolutely love this way of looking at it. This isn't some scary, super complex legal overhaul. It's a natural next step. It's a graduation that your business has earned through its own success. It's really just a sign that you've leveled up. So, how does this whole graduation thing actually work? Well, it's all about splitting your income into two buckets. With an S-Corp, you become an official employee of your own company. So, first, you pay yourself a reasonable salary, what the IRS would see as fair for the work you do. Then, you can take all the rest of the profit as what's called a distribution. And this right here, this is where the magic happens. Your salary, that gets hit with the 15.3% tax, just like a normal paycheck. But the profit distribution, no, that is not subject to self-employment tax. And that one little difference is the entire key to unlocking thousands of dollars in tax savings. Okay, this all sounds pretty great, right? But you're probably wondering, when does it actually make sense to pull the trigger on this? Well, there is a financial milestone, a sort of trigger point, where this strategy really starts to shine. And here it is. The magic number you really want to watch for is right around $40,000 to $50,000 in annual net profit. Once your business starts consistently hitting that range, a little alarm bell should go off in your head to start seriously looking into an S-Corp election. So why that number specifically? Well, making the switch isn't totally free. You'll have some new costs, like running payroll for yourself, and maybe some extra accounting fees. But it's right around that $40,000 to $50,000 profit mark that the tax savings become big enough to easily cover those new costs and still leave you with a nice chunk of change. Now for my favorite part. Let's make this real. We're going to look at the actual numbers and compare the tax bills for the exact same business, just structured two different ways. For our example, let's use a business that's doing pretty well for itself, bringing in $80,000 a year in profit. This is way past our trigger point, which makes it the perfect candidate for this S-Corp strategy. Okay, check this out. On the left, our standard LLC. It pays 15.3% on the entire $80,000 in profit. That's a tax bill of $12,240. Ouch. Now, look at the S-Corp on the right. The owner pays themselves a reasonable salary of, let's say, $50,000. The 15.3% tax only applies to that salary, making the tax bill just $7,650. The other $30,000 in profit, taken as a distribution with zero self-employment tax. And boom, there it is, the aha moment right on your screen. Just look at that difference. That is a huge reduction in the tax bill for the exact same amount of profit. See, it's not about earning less. It's about structuring your business smarter. So what's the bottom line in this scenario? A potential savings of $4,590 every single year. I mean, just think about what you could do for your business or for yourself with that extra cash. So all of this brings us right back to you and your business. We've laid out the problem and the pretty powerful solution. The only real question left is your business ready for its next chapter? So let's just recap the big stuff. A standard LLC gets taxed on every dollar. An S-Corp lets you split your income, and only the salary part gets hit with that 15.3% tax. The trigger point to start thinking about this is around 40,000 in profit. And of course, the most important takeaway, this is a powerful strategy, but please remember, it's not official tax advice. You've got to talk to a real CPA or tax pro to see if it's the right move for your specific business.
So I'll just leave you with this final thought. You have worked so hard to build a profitable business. You've gotten past all those tough early stages. The only question now is, are you ready to graduate to a business structure that actually rewards all that success?